So 50 paise goes to 20 rupees in India. The so-called farm to fork model has too many people in between who basically transport. I don't know what they do. They add up the price. I come from Orissa. In Bhubaneswar, watermelons sell for 20 rupees. You go 50 kilometers outside Bhubaneswar, watermelons sell for 3 rupees. So 50 kilometers can raise the price 6 times in India. Obviously, supply side bottlenecks, and that's not something the RBI from a monetary response can do. That is something where we need policy response. We need a very strong policy response. Has the government had a good policy response? If you look at, since the end of last year, all the way until June, not really. So you had Adarsh, you had CWG, you had one scam after the other. So governance was at the back burner. Winter session of Parliament was gone. Then you had Anna Hazare during the earlier part of the year. You had Baba Ramdev, you had a yoga teacher also coming and talking to us about corruption. And then you had state elections, which essentially meant in March and April that no hard decisions could be taken. Diesel prices were last raised in June 2010. Since then, crude went up 25%. The government did not hike rates until June 2011 to the day 1 year ago. So, needless to say, hard decisions were put on the back burner. However, since June, things have started actually moving up. So, diesel price went out the window. You have a public-private partnership committee, which was sitting every month, all the way till August of 2010. Post-August, they sat in December and then in April. So, they were not, if ministers do not get together to take decisions, how are they going to pass projects? So, luckily, things have changed, things have improved for the better. But we still ask the question, has the government woken up from its slumber? That said, valuations in India, Tarun touched upon it. I'll just go in some detail. Sensex is trading at 13 times, 13 and a half times 1 year multiples. What is its 5-year average? 16 times. What is 1 decade average? 14 and a half times. If I go back 20 years, that will include Harshad Mehta's period when the market was trading at 40 times. So it will take my average slightly higher, so about 17 odd times. Needless to say, whichever average I use, Sensex is cheap at this point. India's multiple relative to emerging markets has also been coming down. What is interesting is that earnings are falling, and when earnings fall, the market suddenly starts looking more expensive because profit numbers come down. But that's not happening. Earnings downgrades have happened, and these valuations are still on downgraded earnings. So valuations look extremely attractive in India from a 1 to 2 year point of view. And needless to say, from a macro perspective, there is growth in India. There is inflation which is going to get controlled. There is some part of inflation which RBI may not be able to control. And for there, we need supply side responses. And remember, all major reforms in this country, all the way from 91, have happened when the government was under tremendous pressure. All of us recall April 91 to June 91, that period when India had to pawn its gold. At that point, when we saw those trucks at Bombay airport going to the Bank of England, at that point, the government said, okay, enough, we have to do liberalization. And India has not looked back since. It took 10 years, but growth is there for all to see. What's our portfolio stance then? After all this, how do we position ourselves to make money? Clearly, there's nothing happening in the next 3 to 6 months. No. So in that sense, just stay defensive. We should, given rates are rising, still rising. We are near peaks, but they're still rising. Stay away from rate sensitives. Rate sensitives are automobiles, large part of whose purchase is financed. Rate sensitives are real estate, which is largely financed, and obviously infrastructure and banks. So stay away from rate sensitives in the near term. We prefer stocks which have very strong earnings visibility. Telecom. RBI can raise rates all it wants. We are not going to stop calling on our phone. Indians are amongst the world's most talkative people. 440 minutes every month, minutes of usage. So, and I don't know if you guys have noticed, most telecom companies have raised prices by 20%. Now, we don't know it because it's not going to show up on our bill at 20%. But for them, their numbers go up by 20%. So, we like telecom. And obviously, given our lifestyles, we like pharma. I don't want to say anything more about pharma. But, if you want to go for the longer term, we like banks. You can't play an emerging country like India, an emerging market like India, by not playing banks. We like banks. And then again, so when rates peak out, credit growth in India will come back, and then banks will be the big story. Again, if you want to play the index in India, almost 28% is banks. So banks is one sector one would definitely like to be in from a long-term perspective. We like IT. Now, this is slightly contra. If I prefer domestic over global, as they say, why would I like IT? The point we are trying to make is US corporate health is very, very, very strong. US corporates, the S&P 500, have more than $600 billion of cash, which is nearly, I think 25 to 30% of their entire market cap. Obviously, it will be a larger percentage now with the markets, the way the markets have fallen. So they are in a very strong position. One has to differentiate between weak growth and shocks to growth. Panic can happen. People can tighten their purse strings, but that does not change financials. US corporates have a lot of cash, and at the end of it, that's going to come down into IT numbers. Infrastructure, again, is one play. You have to play India, you have to play infrastructure. I mean, I don't think there's any, given the paucity of infrastructure in every city, whether you look at urban areas, whether you look at towns, you look at rural areas, infrastructure is one thing India is going to need, and need for the, at least a decade and a half. So infrastructure is one space we would definitely want to be in. We would also like to be in real estate. There are some numbers. India needs 20 million houses for its population, actually. So, realty is one sector one would definitely like to be in, and particularly given the massive leverage it provides. Telecom, from a portfolio perspective, obviously, if one wants to play growth, while in the near term we prefer telecom, in a longer term, RBI, I'll just take that example again. RBI is going to raise rates as much as it wants. We are not going to talk less. Are we going to talk more? Not really. So minutes of usage, Indians will remain the world's most talkative, but that is stop. They'll not talk more and more over the years. So telecom earnings are going to remain strong, visible, but flat. They're not going to, you're not going to see those heydays of growth. And then again, in capital goods, we are neutral because we will wait for the investment cycle to truly kick in. Capital goods are generally late cycle plays. Energy, we are neutral. Why? Because sadly, global commodity prices do not get internalized into India. What happens is, crude prices go up, as I said, 20%. That does not mean diesel prices go up in India 20%. That means diesel prices in India go up by 0%. Therefore, no point in playing energy stocks in India. They are essentially a hedge on all other energy stocks in the world. Pharma, of course, we like, but valuations are expensive, and if I'm playing for growth, I would rather be neutral on pharma. I'll put my money in banks, I'll put my money into infra from a long-term perspective. Again, the same thing. We love consumption in India. Indians love to consume, but at this point, stocks are expensive. They are more a defensive play. You're not going to see, people are not going to start using 2 soaps instead of 1 soap. They might actually upgrade themselves in terms of their brand preferences, but that's not going to lead to growth. I'll just give you an example. Stock like HUL can grow at 12%, 15% in a year. Most large banks can grow at 30% in a year. Where would you put your money? Banks, obviously. Automobiles, again, right now, cost will be neutral. Automobiles have seen very strong growth, but if I want to look from a 5-year perspective, I'll still go out. I'll still like autos. At this point, not really. Metals, we don't like metals. Why? Because what Tarun pointed out, we are very negative on commodities. Commodities, there is no demand. Developed markets are slowing down, and the star of emerging markets, China, is also seeing demand slowing down. So there is no point being, big on commodities. Cement, again, there's a supply overhang. I don't want to go into the details, but India has a capacity of nearly 300 million tons of cement and a demand of only 220 million tons. So at this point, There's just too much supply of cement in this country. Again, on non-banking financial companies, these are leveraged on the rate trade. So at this point in a tight rate environment, one would like to stay out of non-banking financial companies. The same goes for utilities in India. If you want to make money, you have to be in banks, you have to be in infra, and to some extent you have to be in IT. But that's where it is. All right.